called the recent rally a bear market rally. You still think that we're heading lower in the coming year. We talked about Zoom, but I want to ask you specifically about Palo Alto and Cisco, two companies off quarter that have put out pretty decent results and outlooks. Does that make you pause at all and think that this rally could be more than a bear market one?
No, not at all, because the other side of it is look at the PMI numbers that came out this morning. And I think that ties to what you're going to see looking forward, which is up until now, as you talked about, the consumer has seen the slowdown. Well, 2/3 of the U.S. economy is related to services, the consumer. And when that starts to slow down, then you start to see it affect enterprise demand with a lag. And so that's the next phase of this slowdown, where if you remember earlier this year, the big tech companies couldn't hire fast enough. Now they're all in hiring freezes, or in Amazon's case, laying off people because they overhired. And then what you will see, the next phase of this is as consumption starts to slow down, you have less people working at these companies, then enterprise demand is sort of the next phase of this. So for us, we're actually, we own some Amazon, we own some Walmart now, defensive longs, as I like to call it, names that should pick up market share during a recession. And the names that we're really actually shorting is the ones related to the enterprise, because I think that's the next phase of this. Obviously, security, there's like pockets of enterprise that should do better. Security should be one of them. But that's how we're thinking about this on a very big picture basis.
But Dan, weren't we supposed to see at least some slowdown in enterprise over the last quarter? We did see slowing growth rates at the hyperscalers, the cloud companies. But I was kind of struck by Chuck Robbins' comments last week that Europe was actually surprisingly strong for him. What do you make of that? What is the catalyst for the next shoe to drop in enterprise?
Yeah, I mean, I think, if you think about this, as I said earlier, you have seen enterprise slowdown, and it's not across the board, right? Because
but the market's taken it in stride.
Yeah, but remember, how much is Cisco down from its highs? I mean, Cisco, part of this that wasn't talked about in your discussion of Zoom is I didn't hear any of you bring up, well, how much are you paying for it? What's the PE multiple? And that's the critical piece that's missing from a lot of these discussions is, yes, Zoom is down from $590 to $85. And it's showing that the stock can still go down, even when it's down already 80% or so from its highs. And that last piece is the one that people aren't focused on, which is if you look at the overall market, you're still paying a 20 times trailing PE for the S&P 500. When inflation is over 3%, the trailing PE is 15 times. And you've still got estimates going down in aggregate. We can talk about the one-offs like Cisco or Palo Alto Networks, but on reporting Q2 results, S&P earnings went down for 2023 for the first time in 2 years, after going up for 2 years straight off of quarterly results. So you're starting to see the overall numbers go down. And don't forget, every big cap tech company, whether it was Amazon or Apple even, that beat both revenues and EPS, the EPS for the September quarter went down in all of those cases. Microsoft, Facebook, Google, all of them. So that's the big picture. So you don't want to get caught up in the day-to-day moves of, oh, Palo Alto's up today and Cisco's up today. And, well, but Zoom is down. You got to step back and look at this, because this is going to be a long, punishing journey. As the Fed will probably remind us at Jackson Hole on Friday, they've still got to raise rates a lot more from the 2.5% that we're at now to get it to the 3.8, which is where they have forecasts for their medium projections by the end of